Welcome to tradingwithzach.com. In this short video, I'm going to show you the most powerful chart settings that you should be using when trading the markets. A bit about my background: my name is Zach, and I of course run tradingwithzach.com. I'm an options trader, and I offer an options alert service to my members, and I teach my members how to trade the US stock markets consistently, responsibly, such that we can make very, very good returns over the course of the year. So let's get straight into it. For my charts, I use two time frames. One is the daily chart, and I have that on the screen on the left hand side, as you can see here. Each candle that you can see here represents 1 day's worth of price movement in an underlying stock. In this case, we're looking at the SPY, which is the ETF that tracks the S&P 500. So this big green candle, for example, meant the SPY rose from here to here during that trading day. Red candles means it went down during that trading day. And of course, the wicks show the high and low of the price movement on that given day. I use 3 moving averages. I have the 200 moving average, which I have colored in red, the 50 moving average in yellow, and the 20 moving average in blue. If you come and join my site, you'll learn more about these moving averages and how we use them to profit. But these are the settings that I have on my charts. Now, most importantly, on the right hand side, I have the weekly chart set up, meaning that it will show me exactly the same price movement, but it will consolidate it into fewer candles. Whereas on the left, each candle represents 1 day's worth of price movement in a stock. On the right hand side, each candle represents 1 week's worth of price movement, or rather Monday to Friday's worth of price action. I use the same moving averages on the weekly chart, so I've got the 200 moving average in red, the 50 moving average in yellow, and the 20 moving average in blue. Because this is now a weekly chart that we're looking at on the right hand side, the moving averages will form completely differently. So for example, here you can see the 200 moving average is at a price of 198, whereas on the daily chart the 200 moving average is at a price of 216, because the average price of the candle close will consequently be different depending on whether we're using the daily chart or the weekly. Anyway, enough of that. Let me just get straight into it and show you how the chart settings I use give me an edge in the market. And it will give you an edge too, especially if you come and join me on tradingwithzach.com. So let's move to our first trade setup, looking at the stock GDX. This is the ETF that tracks the largest gold miners. And if we just scroll back, looking at the daily chart on the left, you can see in January 2016 the ETF made a low here at around $12.60, and during the first half of 2016 it rocketed all the way to $31.50. Now, it's no surprise after making such a spectacular move higher that the ETF started to come down in price, and by the end of 2016 it came down to $18. Now, looking at this chart here, the high was made in the middle of August. Looking at this chart, one would not be able to determine that by looking at the daily chart. However, let me show you why looking at the weekly chart, which very, very few investors do, let me show you why looking at the weekly chart will give you an edge in the market. We have here a topping tail which you can see on the weekly chart, because of course the candles are forming on a weekly basis. You cannot see any topping tail here at all on the daily. So looking at the weekly chart gives us an edge, because immediately we can see that this is a top in the ETF, and consequently over the next few weeks the stock price came down significantly. So that's the first edge one has by using weekly charts. Let me show you something else. Here's a trade I did. Let's go back to the middle of 2016. Looking at the stock LinkedIn, let me just scroll back here. Right. This is something we call a bull flag. You can see we have a nice band of consolidation sideways. LinkedIn, let me just go back. February 2016, LinkedIn was up here around $200. The stock dropped in February on bad earnings and came down significantly, dropping almost over 50%. However, by March and April, the stock price was starting to recover. Come May 2016, you can see this formation here. This is called a bull flag. We have risen above the 20 and 50 moving averages, and we are moving sideways in a nice tight formation. We've done this a few times. Now, amateurs that trade bull flags may have traded the stock here, or may have bought options, out of the money options, and they may have bought options that were imminently expiring, thinking that this stock would move up immediately after these bull flags formed. However, as you can see, the bull formation started in May, and it continued all the way to the beginning of June. So if one bought options in May, with options expiring either in the middle of May or at the beginning of June, they would have lost all their money, because the bull flag really hardly started to play out. Now, why was that? Again, let me show you why using the weekly chart will give you an edge in this market. So we've got the same price action here. We've come down to $100 in February. And what happened? Why did this bull flag not play out? Because looking at the weekly chart, we can see we have a descending 20 moving average, and never ever underestimate the power of weekly charts and the power of the moving averages on the weekly chart. This stock could not get a big move higher, or it could not take off, because the 20 moving average was hovering above a price. Let me go forward another couple of weeks. You can see here, now we have cleared above the 20 moving average on the weekly chart. The stock is then free to move higher. Let me show you what happened. Let's look at the daily chart on the left hand side. I'm just going to expand this so we can see we were stuck here. We didn't really move high, and then all of a sudden, once we cleared above the 20 moving average on the weekly chart, the stock price was able to jump higher. Microsoft announced in June that they were buying out LinkedIn, and the stock jumped all of a sudden from $132 in one morning. It went all the way up to $195, which is a rise of around 46% or so. I entered this trade a few days before, when I saw that LinkedIn had then cleared above the weekly 20 moving average. I jumped on board. I said, wow, this stock is making or showing us signs that it is going to move higher. Look at this beautiful textbook bull flag pattern above the moving averages. We've got a nice tight formation of candles here. I said I can't enter this here or here though. I have to wait until the stock price clears above the 20 moving average on the weekly chart. Lo and behold, 6 days later, the stock took off when the buyout news was announced, and the options I had on this, I had the July expiry options, and my options went up 950% in the matter of 6 days. There you have it, why using the weekly charts will give you an edge in the market. Let's move on to one final example before we bring the video to a conclusion. Let's go to the USO. This is the ETF that tracks the oil price. Again, let me give you an example of how looking at weekly time frames will give you an edge in the market. Let me get rid of these lines. Okay. Okay, let's move forward to November 2016. Over here we can see the price of USO, which of course tracks crude oil, came all the way down. It made a sort of high in October, came all the way down, and made a low in November. Now, amateur investors or investors that aren't so well educated on reading stock charts would have waited at the double bottom here. They'd be waiting for USO to come all the way down, and then they would buy it, because double bottoms normally form lines of support. So an amateur would be waiting down here. However, USO never came down that far, and it bounced prematurely, and so one would have missed the trade. However, looking at the weekly chart, if I zoom in to the low in November, we've got this high in October, and we've got this low in November. Those of us that are aware of the power of weekly charts will know that aside from the actual double bottom being support, the first level of support will actually be where the candle opens, the low of the body, not the low of the actual wick itself, the low of the body. So if I line this up here, you will see the low of the body on the weekly chart was support practically to the penny when USO came down in November, and it hit that level of support and bounced. However, looking at the daily chart, if one was not aware of the power of weekly charts and one didn't use weekly charts, one would not be aware why USO bounced at the level that it did, and one would be completely unaware that there was a support level there because you can't see it on the daily chart. Furthermore, let me show you another example of where this occurred on USO. Let me just get rid of this line. Looking back to June 2016, again we've got another topping tail here. So again, you see a topping tail on the weekly chart indicating the stock or the ETF has made a top and the price came crashing down over the next 3 months. But again, looking back at May, the high in May, on the daily chart, there is no signal there. There's nothing there that would tell you this is a top in the stock. You've got to look at weekly charts. Furthermore, where that topping tail occurred, we were into the 50 moving average, which was a down sloping line. Very similar to the LinkedIn trade, in that when the moving average is above us, it will prevent the price going up until we've cleared above the moving average. In this case, we stayed below the moving average and came crashing down. But if you look closely here, we came down and made this low in August. Again, an amateur would have been waiting here at the double bottom low, or possibly here. However, where did it bounce? The USO bounced not at the low of the candle, but at the low of the body as seen on the weekly chart. So if I put a line in there, USO came down, the low of the body, not the candle, the low of the body was support, and hence USO went up. So you would have been able to enter the trade practically at the low. An amateur would have been waiting here and would have missed out on the trade. So there are a few examples as to why weekly time frames are so important to use, and you've also got a glimpse as to the correct moving averages that one needs to use: the 200, the 50 and the 20, both on the daily and weekly charts. And one last word of advice: you've always got to have both time frames on your screen at the same time. I struggled in my my first few years of trading. I didn't really appreciate this, and I was switching forth between the weekly and daily, and it wasn't until I had both time frames on my screen at the same time that my trading really started to excel. Now here's the great news: if you want to access this stock charting platform, it's free of charge. I'll say it again, it's free of charge. Use the link above this video. Click on the link, which will not only take you to free stock charts, where you've got this free charting platform, but it will also load for you already, right from the start, the correct moving averages and then the correct time frames. You'll have the daily on the left and the weekly on the right, and you will have everything set up in exactly the same way that I've set up. You'll have a winning formula, and your charts will be set up exactly the way they should be to allow you to profit for life. Furthermore, what I want you to do is go to my website, tradingwithzach.com. If you've not already submitted your email address, jump onto tradingwithzach.com. Enter your email address, and that will allow me to keep in touch with you and guide you and take you by the hand and show you how to trade the US markets consistently, profitably, successfully for life. I look forward to having you on my site. Thanks for joining me.